required part, they are telling us that we use standard absorption costing. You use standard absorption costing. This is not marginal. This is not marginal costing. It is absorption costing. There is a difference, and I'm going to tell you where there is a difference. Okay, so you are using absorption costing to prepare a statement that reconciles this company's budgeted profit with the actual profit for the month of October 2018. So here you're preparing basically the reconciliation statement. You're preparing this company's reconciliation statement. And when you observe, you are basically focusing on profit. You're basically focusing on profit. As you reconcile, remember reconciliation statement, you always need to reconcile what was budgeted, is it equal to the actual? And how do you reconcile? How do you reconcile? You will always need to know, first of all, what is the actual. You first know what is the actual profit. You want to reconcile the budgeted profit with the actual profit. So the starting point, you need to know what is the actual profit, because your reconciliation statement at the end of it all must be equal to the actual profit. Okay, and how do you get the actual profit? How do you get the actual profit? The actual profit is for you to get the actual profit. The actual profit. Assume this is your one side work. Actual profit is equal to total actual revenue. Total actual revenue. Total actual revenue minus total actual costs. Okay, that's how you can get actual profit. And when you observe what you have here, what you have in the case study, you will always be given information. The information that talks about budget, and also the information that gives you the actual results. What was budgeted and what is the actual result. Okay, for us, we are interested at this point, we are interested to know what is the actual result. You have the company, okay, you have the standard cost card. This is the standard cost card. This is the company that makes, this is a standard cost card for making a dress, one dress. Okay, as you make a dress, you need different items. You need materials, you need labor, you need to look at those variable overheads, you need fixed overheads. Okay, but this is just the standard cost card, and it is based on the budget. Okay, you have the budgeted output, and you have this was the budgeted output as 1,200 dresses, but the actual results, at this point we need the actual results. The actual results were as follows. You have the production. The company manages to manufacture or to produce 900 dresses. Okay, and they used the materials. These are the materials they used. The labor, they paid the labor hours. This was the labor hours used. Okay, okay. Now I want you to get your calculator. You get your calculator. You know how we get total, how we get a profit. If you get this figure minus this, minus this, minus this, minus this, what do you get on your calculator?
I was still looking for that. I beg your pardon.
We are looking for the profit. We are looking for the profit. We are looking for the profit. Now, when you're looking for the profit and the examiner has given you this information, when the examiner has given you this information like this, and you want actual profit, how do you get actual profit? We have said that to get actual profit, you get total actual revenue. Total actual revenue. How do you know the actual revenue? From what the company produced, we assume that that's what they sold. We assume that that's what they sold because they had no inventory balances. You get that? They had no inventory balances. So what do you do as you get your actual profit? Get your revenue. This is the actual revenue. From what you managed to produce, you received this. So get this total revenue minus all costs. The costs for materials, the cost for labor, the cost for variable overheads, then the fixed overheads. The balance will be your actual profit. Okay? What is that balance?
I'm getting 36. 36, 37.5. 3,637.5.
What is the company's name? What is the company's name? This is the company's name. So since this is the company's name, we are going to say that STS reconciliation statement. Reconciliation statement for the month of what? For the month of October. For the month of October 2018. Okay. So you are preparing the reconciliation statement. Let me first lay the template. You are going to start with the budgeted. I want you to understand the format, the flow. But start with the budgeted profit. Okay, you will start with the budgeted profit as you lay your template. We will see how we get this budgeted profit. Then, once because you're reconciling the budgeted profit with the actual, okay, you want to adjust the budgeted profit to make sure that it can give you the actual result. At the end of it all, you must get this answer as your final answer. Okay, so you start from the budgeted profit and adjust that. Okay, adjust the budgeted profit. Now, you are going to look at budgeted profit, then look at the sales. After that, look at the sales variance. Look at the sales variance. The sales variances, the sales variances, we have the categories. When you're looking at sales variances, we have the sales price, the sales price variance, the sales price variance. Then we have the sales volume variance. You need to do that working. You need to do that, those workings for the two. Now, you may have the sales mix and the sales yield. If in the question the company is selling different items. But in this question, it's only one item. We are selling only dresses, one product, one type of product, dresses. But you may find that you're selling more than one product. If you're selling more than one product, then you think about the sales mix and the sales yield. Okay? But in this question, I'm not going to talk about the sales mix and the sales yield because we are dealing with one product, one item, that is dresses. Okay? So I don't add those ones. I don't add the sales mix and sales yield. Okay? Now, I continue after adjusting my sales variance. Remember, variances, you can have a positive and a negative variance. You can have a favorable variance. You can have an adverse variance or unfavorable variance. If you find that your variance is favorable, you will be adding it to profit. If you find that your variance is adverse or is unfavorable, you will be reducing your budgeted profit. Okay? Okay, so after getting your sales price and sales volume, you will have the total. You will have the total sales, total sales variance, which you will put here, So the sales price and sales volume you put in the second column. Okay, we will do that. I want you first know the template, how it flows. Okay, then after looking at your sales variance, you can now look at the material variances. The material variances, you have what and what? You have the material, you have the material price, you have the material price variance, you have the material, you have the material usage, variance. You may have the material mix and material yield in a scenario where the company is using more than one material, more than one type of material. Either they are using material A and material B, material A, material B, material C. You have more than one material. So if you are using more than one material as a company to make a product, then you may need to look at also material mix and material yield. In this question, we are not dealing with material mix and material yield. Reason being, we are looking at basically materials. These ones are not categorized into different materials. You just have materials. Okay, so if you have materials, they have not categorized these materials. So you don't need material mix, you don't need material yield. Okay, now material price, material usage, you understand that as a company, you purchase materials. Of course, okay, I'm going to explain these things as we do. What is material price? What is material usage? But you simple understanding that as at the time you're going to purchase those materials, as a company, you set your budget. Probably you predicted to buy these materials at a certain price, but you reach in a market and find that the actual price of these materials is different from what you had budgeted. Okay, that's why you will have a variance. And also you will have material usage. Depending on how you use these materials, you are making dresses. In the process of making those dresses, we want to see, are you really efficient? Are you using these materials efficiently? How do you convert these materials? How efficient are you? Okay. Because in the process of producing those dresses, in the process of making those dresses, there could be some negligence. There could be some inefficiencies. Okay, so if you have that, you add and get the total material variances. The total material variance. So you add the material price and material price and material usage. Okay, so then from there, you are going to look at labor. You're going to look at wages. We are following the template. We are following this template, this one. Materials, now we look at wages, which can be in the form of labor. So we look at labor cost, labor cost variances, labor cost variance. And with labor cost variance, you have the idle time. You have the idle time variance. Idle time will always be there in a scenario where you find that the total actual time worked is different from the total time paid. Okay, you have worked for let's say 100 hours, but the company paid for let's say 90 hours. So there is what? There is some, for example, what I'm trying to explain, when you look at this scenario, in this question, I believe they gave you those things. The company paid, this is the actual hours worked. Okay, this is the actual hours paid. This is the actual hours paid. The actual hours paid. You were paid for these hours. But the standard, the company operated for only this. The company operated for 1,200 hours during the month. What comes into your mind? It automatically tells you that there is a difference in this time. You were paid. You were paid for this, yet you worked for this. Okay, so there is some idle what? There is some idle time which you need to compute. And we are going to see how how difference between this and this cost variance. The idle time cost variance will be the difference between this and this. Then we ask ourselves, how much is per hour? What is the cost per hour? We are going to see those things, how we get this idle time. Okay, then we look at another thing. We need the labor rate variance. Then we will need the labor efficiency, variance. The labor rate will be as a result of the price. You predicted to pay this, but you're paying this. The rate per hour. You predicted to pay at a rate per hour equivalent to a certain amount, but you're paying a different figure. We are going to see that. Labor rate. Then labor efficiency. How efficient are these guys? We are going to see. You may have labor mix, labor yield if a company is using different categories of workers, semi-skilled, skilled, casual workers. So they are, if they have categorized, then you also need to think about labor mix and labor yield. Okay, so here after this, you will have the total labor, total labor cost variance. You will need that. And of course, you need also to go ahead and look at the variable. You need to go ahead and look at the variable overhead variance, the variable overhead variance. And this one, you look at the variable overhead expenditure variance. Then also you need the variable overhead efficiency variance. You need those two. Then add them and get the total. Add them and get the total variable overhead variance. So you will add those two and get the total. Okay, please understand the flow so that you don't mess up if you meet this question. Okay, then next, because in the question you have fixed overheads, we'll need also to look at the fixed overhead variance, the fixed overhead variance. And this one, you are also going to look at the fixed overhead expenditure variance, then add the fixed overhead volume variance. You need only those two and be in position to get your total fixed overhead variance. And that will be all. That will be all. If you have all these things, if you start from here, you get your budgeted profit, then you add or subtract depending on whether the figure is favorable or adverse. If a figure is adverse, then you'll be subtracting. If a figure is favorable, you'll be adding. So you'll be starting from here. Get this plus this, or minus depending on the kind of variance. At the end of it all, your answer here should be your actual profit. Should be your actual profit, equivalent to what you got at first, 3,600 what? 37,500. At the end, we must be having this. For us to say that we have reconciled, we must be having this. Okay, so the question is, how do we get these variances? Are we still together? Are we still together?
Yes, yes.
Okay, so how do we get all this information? Assume this is your working. Assume this is your working. So you handle, so this template should be on your first page, your workings should be on the second page. Okay, now we want to start with how do we get, first of all, our budgeted profit. How do we get our budgeted profit? For us to get our total budgeted profit, for you to get the total budgeted profit, you will need, of course, you need the budgeted, the total budgeted revenue, then you also look at the total budgeted, the total budgeted costs, costs. How do we get our budgeted revenue? For me to get budgeted revenue, I go back to my working, or rather my scenario. Of course, I need revenue. So for me to get revenue, I need, you are given the standard selling price. This is the standard selling price. This is the standard selling price. And if I'm having standard selling price, what was my budgeted output? I had budgeted to sell how many dresses? Are you seeing this? The budgeted output for the month of October 2018 was 1,200 dresses. That's what the company had budgeted for. So for me to get total revenue, total budgeted revenue, I simply get the selling price, which is 35,000, then times the number of dresses, 1,200 dresses. What do you get? What do you get? This is 35,000. So 35,000 times 1,200, and that's what I have. And colleagues, we are in last minutes. If something is not clear, you ask. I don't have time to repeat. There is no that time. We have to move together. Okay? So how do you get the budgeted costs now? How do you get the budgeted costs? For me to get the budgeted costs, costs, are you seeing this standard cost? Are you seeing this standard cost? This standard cost you're seeing is per dress, it is based on a dress. So I want this total cost. The total cost is the total variable costs. Total variable costs plus total fixed costs. So here examiner has helped you. You have already the total cost per dress. This one plus this one plus the variable plus the fixed. So you have the total costs. You have the total budgeted costs, including the fixed one, because we have to capture the fixed. If you were looking at the marginal costing, then you don't add this 6,000. For you, you get the total variable costs per dress by getting this plus this only. That will be your total cost, total variable cost per dress. But here we capture the 27,000 because we are using absorption costing. Is that clear? Is that clear? So
Yes.
I get the 27, this 27,000, then times the output now, the number of dresses, because this 27 is per dress, it is the cost per dress. It's the cost per dress, It is here. They told you this is it's a standard cost card for making a dress, okay? So you get that 27,000 times 1,200, 1,200. What do you get? This is 27,000 times the 1,200. That's what I have. That's what I have. So get your budgeted, the budgeted profit. So I subtract. My budgeted profit will be this one minus this one. That is my budgeted profit. You have your budgeted profit here. Put in your template. Put in your template here. You have the budgeted profit. Put it there. Put it there. Okay. We are done with that. We are done with that. Then number 2, we proceed to now to material variance, to what? To sales? Yes. I think we are going to sales. Now, when you're handling sales, using absorption costing variance, and how do you get the sales price variance? There are some steps that you need to follow. Now, before I talk about this, when you're looking at the absorption costing, for you to deal with sales price variance, you need the standard, you need the standard, you need the standard, you need a standard profit. You need the standard budgeted profit. You need the standard budgeted profit. And how do you get that standard budgeted profit? Using this, you need the budgeted, budgeted profit per unit, which will be equal to, the budgeted, this will be the budgeted selling price per unit, budgeted unit selling price minus the total unit cost. Total, because you're using absorption costing, so you will be looking at the total unit cost. You will not be looking at only variable cost. Okay, you'll be looking at the total costs. If you're using marginal, it is budgeted unit selling price minus the total variable cost, the total unit variable cost. Okay, so what is your budgeted unit selling price? One dress, what is the budgeted selling price? It is what? We saw that it is 35,000. Then minus what was our budgeted unit cost, the standard cost? It was 27. Okay. So what do you get as your budgeted profit per what? It is 37,000. This one minus 35,000 minus 27,000. And that's what you have as your budgeted profit. After getting your budgeted profit, you need also, these things we are doing will be applicable somewhere. So you will need also the actual profit, per unit, the actual profit per unit. So when you're dealing with sales variance, always start with these two workings. When you're dealing with sales variance, always start with these two workings. So how do you get the actual profit per unit? How do you get the actual profit per unit? For you to get the actual profit per unit, it will be equal to the actual selling price, the actual selling price, the actual unit selling price, the actual unit unit selling price, then minus minus, don't say minus the total actual variable, no, minus minus here, this one remain the same, the total budgeted, the total budgeted unit unit cost. Don't use here the actual, reason being that as we reconcile the sales, we assume that these variable costs will remain the same. So those ones don't use the actual. Don't use the actual here. Use the budgeted one. Okay, so the actual unit selling price, the actual unit selling price is what? At the end of it all, the company sold dresses at how much? They produced this. They made these dresses. They made these dresses and they were in a position to earn this money. So I can get the unit selling price by getting the total revenue over the quantity. I get the 228 million. I get this 28,800,000. Then I divide by 900 so that I can get unit selling price. Then minus the total budgeted unit cost, which is 27. Okay, so what do you get? Just press on your calculator and tell me. When you press on your calculator, what do you get? Open your calculator, open bracket 800,000 divided by 900 minus 27. That's what I have. 5,000. Let me hope that's
Okay.
what. Okay. Then now, once you have these two, get your sales price variance. How do you get the sales price variance now? To get your sales price variance without cramming, if you, what was your budget? What was your budget for one dress? What was your budget? You had budgeted to save one dress at how much? The one dress was budgeted to be sold at how much? Okay. When you look at the budgeted revenue, what was our budgeted revenue? Do we have the budgeted revenue? Do we have the budgeted revenue when you look at this? Okay. To explain it well, because we need to rely on this information. Explain it well. Because now we are not going to rely on the revenue. We are going to rely on this profit. Okay. As a company, you had budgeted to earn how much on one dress? One dress, you had budgeted to earn how much as profit? If you sell one dress, you had budgeted to earn how much as profit? So one dress was budgeted to give us shillings what? Isn't it 8,000? That was our budget. That was our budget. One dress to give us, if we sell one dress, we are going to earn 8,000. That was our budget. That was our budget. The question is, how many dresses did we actually sell? How many dresses did we actually sell? The dresses, the actual quantity we managed, the company produced 900 and they sold those 900 because there was no inventory. So it means that they sold those what? They sold all those. So we are going to say that now, how these 900 dresses, these 900 dresses would have yielded how much? Would have yielded how much? Would have yielded how much? So it is 900 according to your budget. It would be 900 times what? 8,000. Here you get how much? According to your budget. According to your budget, you could have earned this money. According to your budget. Okay? But did you actually earn this money? Did you actually earn this money? But the actual.
Pardon for me, on one dress is equal to 8,000.
Okay. All right. We are saying that this is sales price variance. Now, for you to understand, start from what was your budget. As a company, I had budgeted that if I sell one dress, I am going to earn the profit of what? 80,000. This one, the budgeted profit. You get, If I sell one dress according to my budget, remember this, the profit you have here is as a result of also selling price. In this one, within this figure, there is the selling price. But for you here, as you do this number, be asking yourself, as the company, they had budgeted to earn how much in terms of profit on one dress. Okay? So that's why it is good to start with these workings. That's why it is good to start with these workings. Agree, is it now okay?
It's now okay.
So this is what the company had budgeted to earn on one what? On one dress. So they actually made how many dresses? 900. So according to my budget, these 900 dresses would have yielded how much? According to my budget. I expected to earn this. But in actual sense, you earned how much? But actually, you earned how much? But actually yielded what? Actually yielded how much? Actually, what you received is 900 times what? Times the actual profit, which is 5,000. You get what? You know where this 5,000 is coming from. Because this is the actual profit. This is what you actually received per dress. So it is 900 times the 5,000. Okay. So the question is, do you have, if you compare the budget, this is like the budget, this is the actual. Do you have a favorable variance or the variance here? Is it a favorable variance or adverse variance?
I think it is adverse.
You actually received less compared to what you had budgeted, and that is adverse. So you get this minus. Okay, to you, okay, let me also like maintain. This is adverse. You put here the word A. You put like A to show that this is adverse. Show that this is adverse. But to me, because I'm using Excel and I don't want to be wasting time, if it is adverse, let me be putting it as a negative. But for you, don't write as a negative. Write a figure as positive, but put that word adverse. Adverse, like this. So this is my sales variance. I bring it here. Sales price variance, I put it here. I put it here, which is this one. This is from, this was working number 1. This is working number, okay, this is 1. This is working number 2. Guys, don't keep quiet where you are not understanding. Okay, so we are done with that sales price variance. Next, we need the sales volume, sales volume variance. Just understand the flow. When you are getting sales volume variance, what do? Volume, now you are looking at what you expected to sell in terms of quantity. Volume, what you expected to sell in terms of volume. And now here, the simple logic will be compare the budgeted dresses to be sold, the budgeted dresses to be sold with the actual dresses sold, budgeted sales. The company had budgeted to sell as these are sales units, budgeted sales units. The company had budgeted to sell how many dresses? The company had budgeted to sell how many dresses? According to the budget, they had budgeted that the output for the month of October as what? 1,200. 1,200. That was the budget. 1,200. But they were in a position to actually sell how many? They were in a position to actually make and sell. They made 900 and sold 900 because there was no inventory. So the actual sales 900. So according to you, do you have a favorable variance or adverse variance?
Have adverse.
We have adverse. So you get adverse. Since it is adverse, I want to make sure that my figure is negative. So this variance this is a variance. This is a variance and it's adverse. But this is in terms of units. These are dresses. These are dresses. We don't report in terms of units. We report in terms of amount. So for you to report in terms of amount, convert units into amount. So you are going to multiply by, you're going to multiply by the budgeted, don't multiply by the actual, multiply by the budgeted, multiply by the budgeted profit per unit, And the budgeted profit per unit is was what? The budgeted profit per unit was what? The budgeted profit per unit, it was it what? Was it 8,000?
Yes, I think yes.
Okay, so here you get the amount. You get the amount, which you should report in your template, and you're done. You're done with this one. This is your sales. This is your sales volume variance in terms of amount. So you report this. Okay. Martha, are you still with us? This is note number 3. Are you still seeing
Yeah, I'm seeing the screen.
So let's report. We report this. We are done with that. We are done with this. So since I am done with sales, I add. If this is adverse on calculator, you put it as a negative. If a figure is favorable on calculator, you put it as a positive. So to get my total sales variance, I get this negative this plus negative this. And that is my total sales. That is my total sales variance. And now we proceed to the material. We proceed to material price variance. So with material price variance, how do you get this material price variance? How do you get this? Now we are looking at materials. The question is, these materials you are looking at are measured in terms of what? What is the unit of measure? You are buying these in terms of what? What are you basing on? Let me see the unit of measure. The unit of measure, materials used, they are in square what? In square meters. They are in square meters. Now the question will be, are you seeing this? Are you seeing this here? This is direct materials. You will be asking yourself as a student, you will be as a manager, as a student answering this, as a manager, you'll be asking yourself, I want to buy materials, but what is my budget? What is my budget? I want to make dresses, but I can't make dresses without materials. I will have to go and buy these materials. As you plan to go and buy, you should be having your budget. So what is your budget? What is your budget? The question is 1 square meter as material. 1 square meter. What is your budget to buy 1 square meter? What is your budget for 1 square meter? And the budget for your 1 square meter, you will get it from your standard cost card. Here, this information given 1.5 square meters of cloth. Each, you see this, each at. Remember, this is standard cost card. They are telling you indirectly that for you to make a dress, this dress, you need, in terms of quantity, you need 1.5 square meters to make one dress. You need 1.5 square meters in terms of quantity. Okay? That's what you need in terms of quantity. Now, at this point, we are not dealing with material usage. We are dealing with material price. We are not dealing with material usage or material quantity. We are dealing with material price. So because I'm dealing with material price, I am going to be asking myself, now, I want to buy these square meters because for me to make one dress, I need 1.5. So if I go to market, I expect 1 square meter to be at what? At 9,000. That is my budget. That is my budget. Students normally make mistake and they consider this one, which is wrong. This 13,500 is the material cost per dress. It is not the material cost per square meter. this 13,500 is the material cost per dress, per one dress. That is the material cost per one dress. But this 9,000 is material cost per square meter. You want to go to market to your supplier and buy these square meters of cloth. Don't make that mistake, my friends. Don't make that mistake. You're going to buy square meters, you're not going to buy dresses. So what is the cost of 1 square meter? Your budget. Your budget is 9,000. Your budget is 9,000. So since that is your budget, the question is, how many square meters did you actually use? How many square meters did you actually use? You used how many? From the actual information, the materials used, square meters, are these ones. So you are going to say 1,125. We're going to say that 1,125 square meters. These square meters would have cost the company how much? Would have cost the company how much? According to the budget, you get 1,125 times 9,000 times 9,000. You get how much? Let me hope I'm not complicating life. I'm trying to explain like in a simple way without cramming. I don't want to use formulas. Okay. This is according to your budget. This is what you could have incurred as a company. But what did you actually incur? What did you actually incur? But actually cost how much? But actually cost how much? The actual cost, the actual material cost. The actual material cost. The actual material cost is 0. Where is the question? The actual material cost will be, you have this figure, isn't it? This is material cost. This is what you actually incurred. This is what you actually incurred. This is what you actually incurred. So if you don't have this overall amount, because this is overall amount, if you don't have this overall amount, what do? You get the 1,000. You get the 1,000 here. It would be like 1,125 times the actual material cost per square meter. Actual material cost per square meter. But now you don't have that actual material cost per square meter. So simply put the other figure, which is what? The 10,680, 7,500. So the question is, do you have a favorable or adverse? Someone tell me, a favorable or adverse? This was the budget.
Yeah.
This was
This
the
was
budget, but
adverse.
this is what they actually incurred. So it's adverse. They incurred more compared to the budget. That is not favorable. So that is adverse. That is adverse. So this is Material, this is your material price. After getting a variance, ask yourself, is that variance in terms of amount? Yes, this variance is in terms of amount. So I can immediately report. So I go and report here, where I have material, where I have the material price. This is not number 4. I report and I put what? I put put this one. You're done. Let's move on to the next. Next, we have the material usage, variance. Now usage, you're looking at the quantity. It could be the material quantity variance, material usage variance. It is the same. Now, I always ask yourself when you are dealing with this material usage, always ask yourself, what are you actually making? What do you want to produce? What are you actually making? You're making dresses, isn't it? You're making dresses. So the question is, for me to make one dress, I need how many square meters? I need how many square meters to make one dress? So when you're dealing with this material usage, be asking yourself, what are you actually making? What are you actually producing? And to produce one item of that, you need how many quantities? So for me to make one dress according to the budget, for me to make one dress, this is the way you should be explaining to your board, because those guys don't want to hear the formulas. You need to look for ways to explain to them these things. That we are making dresses. For us to make one dress, we need 1.5 square meters for us to make one dress according to our budget. Okay? We need 1.5 square meters. That's what you need. Then the question is, how many dresses did you actually make? How many dresses do you actually make? You made how many dresses? That will be the question to ask yourself. Okay? So from the question, we saw that the company produced 900, the company made 900 dresses, the actual. Okay? They made 900 dresses. So these 900 dresses would have used how many square meters? Would have used the 900 times 1.5 according to our budget. You get 900 times 1.5. That's according to the budget. Okay, but they actually used what? But they actually used how many? How many? They used how many square meters? These are square meters. But they actually used how many square meters from the question? But they actually used how many square meters? Material used. They actually used what? 1,125. Isn't it, guys? 1,100. Those are the material that were used. 1,125. square meters. So the question is, do you have a favorable variance, or this is a variance? Is it a favorable or adverse? This was your budget, but are you still with me? This was your budget.
Yes,
You would
yes,
have
we are
used
following.
this was our budget, but we actually used this. So, is it good to the company?
Yes, it is good.
It's good to the side of the company because they saved, isn't it? They saved. They used less. They used less compared to the budget. That shows that they are efficient. They are efficient in terms of using materials. So this is favorable, not negative. So this is favorable. But this is in terms of square meters. We don't report in terms of square meters. We don't report in terms of square meters. We report in terms of what? Amount. So you convert, as you convert this into amounts, you're going to multiply by, simply multiply by the standard, simply multiply by the standard price, the standard price per square meter. So when you're converting those ones, always use the budget, don't use the actual. Like the same way I told you here, when you're converting this one, you use the budgeted profit. Here you see that we are using the budgeted price per square meter. What was our budgeted price per square meter? What was in terms of amount? We had budgeted to spend 9,000, isn't it, per 1 square meter? That was our budget. So if you convert in terms of amount, you get this times, and you're done. This is favorable, don't forget, the figure will be positive. So this is your material, this is your material usage. This is your material usage variance. Material usage variance. Is it okay? Are things moving
Yes.
on well?
Yes, we are following on very well.
There is following, there is also understanding, okay? So don't just follow.
But is this a section A number or B?
Pardon?
Can it be brought in section B?
This is section B. It's a number. We are doing a past paper. Section B. It's a past paper question.
Should be question 1.
Taking what? 14 marks. MDC questions, don't think that they will always be direct or some. These MDC questions require time. You need to be very fast. You need to be very fast. You meet this one, you meet a budget question, you meet a simplex method question. You need to be very, very fast as you answer these MDC questions. As I told you, MDC, you need to maximize section B. Then make sure on section A you can score above 18. I am not giving you many marks. At least 18 marks in section B, rather section A. But on assumption that you have fully maximized the section B. Because for you, Section B, you do 3 numbers. 3 numbers require a lot of time. The percentage of finishing in this paper is minimal. It might be hard to finish. But for you, as you answer, can I raise 50? Can I raise 50? Based on what I have done, 3 hours are enough for you to raise 50. Not 100, just 50. Okay? I understand you may not finish, but 3 hours are enough for you to raise 50 max. So you need to be very, very, very fast. Very, very, very fast. And if God can help you and you get a number in section B, where you can score like 15 marks, please maximize that number. Like this question, it was taking a lot of time. You are using inspection method. You are using you are preparing reconciliation statement. You are preparing, you are using simplex method. Trust me, you are going to attempt these 3 numbers in section B. But the question is, will you finish them because these are 3 numbers in section B when you have not yet looked at section A. So you need to look at this. Now, by the time you finish this, start with theory. Start with theory in section A. Then you write something on in terms of calculation. The strategy you use will be the one to help you in MDC. MDC paper, and the moment you fail it on first attempt, it might be trigger for you to pass that paper. If you fail a paper on first attempt, it becomes very hard to pass that paper. Yeah? It becomes hard because you will start mixing it with other papers. By the time you realize you don't have time for it, you again fail, you again fail, you again fail. People say that they have failed 8 times. For you think it is a joke, but it is these things that are real. The strategy you use in an exam, my friends, will matter. And my prayer is that once you get a number which you see that it is your savior, be fast, but make sure that you don't make a lot of errors, because that is a number to save you. Be fast, but accurate. Okay? Endeavor to do all numbers. Even if you're gambling, do 4 numbers. Like examiner wants to say that you have done 4 numbers. At least gamble, but make sure you do all. Okay, so let's continue. And in your mind, don't start saying, me with standard costing, me with this topic, I can't do it. Trust me, you're killing yourself, and the topic you're ignoring might be the topic which is easy in an exam. Don't ignore a topic. Don't start saying this is hard. This is hard. It might be hard past paper, but easy in your paper. Okay? Okay, next. Next, we need the, I think we are done with material usage. We can report. And this is a discussion. The time we take to do a number, it's because it's a discussion. I do over explaining. It's a discussion. When you are on, give a number like don't exceed 40 minutes. You leave the number. Actually, you should be using only 36 minutes. You see time is getting, you leave the number and first do call on other parts. Because you may be saying, I want to maximize it. I want to maximize it. Yet what you're doing is even wrong. Leave. You can come back later. Okay, let's see. Let's proceed from our template. From our template, we have idle time. Let's try to be fast. Still have a lot to idle time. Idle time. How do we get the idle time? The idle time variance. The idle time variance will be this one. It is always the adverse. There will never be idle time which is favorable. You're paying for. You're paying more. People were not doing work. When you look at what the actual working time, was only what 1,200. That was the actual working time here. Yet you paid this. You paid for this time. Idle time will never be favorable. You are paying for the time not actually worked. But there could be reasons why these workers were not working. Probably it could be that the system was down. It is not workers' fault that they are not working. It could be that there was some delay in the supply of materials. It is not the workers' fault. Okay. So that's why the adverse will always be there. The idle time will always be there. Okay, so we are going to get the actual time paid. The actual time paid was what? 1,225. 1,275. The actual time paid. The actual time paid is this one. This one, the actual time paid, it is this one, minus the actual time worked. 1,200 times 1,000 minus, okay, minus 1,200, then times the actual price, the labor rate per hour, the labor rate per hour, which is how much? Which is shillings. You are paying per hour. You are paying how much? Basing on this question, per hour you are paying how much? According to the budget. This is direct wages. You're planning for you to make one dress, you need 1.5 hours, but you will need to spend per hour, you are spending 2,000. So you multiply by that 2,000. You multiply by that 2,000. I want to be sure that you are listening to me. Are you on? Okay.
Yes.
So here you get how much as the idle time variance. So we get the difference 1,275 minus 1,200, then times the 2,000. That is your figure. That is your figure, but it is adverse. It is adverse. Okay, you report that in your template as a negative 150. You report it as a negative. You report it here is working number 6. This is negative 150. 150,000. Okay. So for you, as you report in your template, don't be putting negatives. What you can put this figure 150,000, put adverse. after that, put adverse. Or when you have indicated the other side adverse, you can put the figure in bracket. It will help you to know that I should add or I should subtract. Okay, next, we need the labor rate variance. Next, we need the labor rate. This is working number next. Labor rate. This is labor rate variance. Now, how do you get this labor rate variance? How do you get this labor rate variance? How do you get this labor rate variance? Labor rate, you are looking at how you're gonna pay your workers. You are paying these workers based on what? Is it per hour or per output? They are basing on the standard cost card. These guys are paid per hour. So the question is, what is your budget for 1 hour? What is your budget for 1 hour? You're planning to pay these guys how much? It is shillings. We have seen that it is shillings 2,000 per hour. 2,000 per hour, according to the budget. That is according to the budget. It is here. Direct wages, this is 1.5 hours. This 1.5 hours means what? It means that for you to make one dress, you need to use 1.5 hours to make one dress. But per hour, each time costs what? Each time costs 2,000. Each time costs what? 2,000. Okay. That is the first part. Then the question is, how many hours did you actually, these guys, how many hours were actually paid? As a company, you paid for how many hours? So here put 1,275 hours. This is the labor hours paid. Hours paid. Don't put hours worked because you're looking at labor rate. Put the hours paid. Okay, so 1,275 would have cost how much? Would have cost how much? So you get this 1,275, then times 2,000. Times 2,000. You get how much? 1,275 times 2,000. That's what I have. That is in amount. But actually the company paid what? But actually cost in terms of labor cost from our actual results. From actual results, the company paid the labor cost of how much? The company paid labor cost of this 3,825. So adverse favorable. Adverse favorable. This is the budget, this is the actual.
Adverse.
This is adverse. So this is adverse variance here. The variance you have here is adverse. You paid more compared to the what? You paid more compared to what you had budgeted to spend. So that is the adverse. Report, because that is already in amount. This is already in amount. So you can report here where you have labor rate. This is working number 7. And the amount is 1,000. 275. Okay, next we need the labor. Next we need the labor efficiency variance. Now labor efficiency, you are looking at the time you take to make a dress. One dress requires how many hours? For you to make one dress, these workers should use how many hours? To make one dress, you need 1.5 hours. You need 1.5 hours. I hope you saw where is this one coming from. So how many dresses were made? The company, the actual dresses were 900 dresses. These dresses would have used how many hours? Would have used how many hours? 900 times 1.5. So these ones would have used how many hours? 900 times 1.5. These ones would have used these hours. These are hours. These are hours. But actually used how many? But actually I used here. You put the labor hours worked. Labor hours worked. The actual labor hours worked, not paid for. The actual labor hours worked were how many? Were how many? The actual labor hours worked were how many? Oh, you guys, you can't hear me.
Can hear you.
Actual labor hours worked 1,200. These ones were paid. These are labor hours paid. But labor hours worked are these ones.
1,200.
Okay. 1,200. So note the difference. Note the difference. That when you're dealing with efficiency, you look at labor hours worked. But when you're looking at labor rate, you look at labor hours paid. Sometimes you'll find that labor hours worked is the same as labor hours paid for. So there is no idle time. If actual hours worked is equal to actual hours paid, oh, then there is no idle time. So here, the variance, adverse favorable. The variance, adverse favorable.
Okay. We have adverse. Let me see. No.
This was your budget.
We have favorable. We have favorable.
Budgeted to use these hours, but you actually used this. You are efficient. This is favorable. You are efficient. You used less hours, so this is favorable. But these are hours. These are hours. Convert them into shillings. So we are going to multiply by what? What do you think? The budgeted or the labor per hour in terms of shillings. So that was how much? Labor rate per hour, it was 2,000. So get 150 times the 1.5. So that is your labor efficiency. You report. Let's report. This is favorable. This is favorable. So let's report here. Note number 8. This is 300,000. 300,000. Favorable, so that is not negative, it is positive. Okay. Next, now we can add now. We get total labor cost, labor cost variance, negative this plus negative this plus positive this. That's what I have as total labor cost variance. So we proceed. Next is what? Not number what? Next is variable overhead, variable overhead what? Variable overhead what? Variable overhead expenditure. Variable overhead expenditure variance. How do you get this? How do you get this? Very easy. Very easy. Expenditure. Now, ask yourself. You see here, when you look at the variable overhead from the question, from the standard cost card, the variable overhead, the budget is what? Are you seeing the budget? The time will always be the same. The time will always be the same. If you are not given the time for variable, always know that it is the same here. The time will always be the same to make one dress. But the difference will always be on amount. The amount here, the amount here, amount here. So with variable overhead, the expenditure, the company is planning to, per hour, every hour, the company is going to be paying what? 3,000 as the variable overhead. So per hour, 1 hour, the company is planning to pay. The budget is to pay. The budget is to pay what? 3,000. So the question is, now when you're looking at the variable overhead, don't look at the actual hours paid. When you're looking at the variable overhead, look at the actual hours worked. So you're going to say that 1,200 hours worked. These are how hours worked. Would have cost the company how much? This would have cost the company how much? This would have cost the company how much? Would have cost the company how much? 1,200 times 3,000. It would have cost the company that amount of money. It would have cost the company that amount of money. That is according to the what? According to the budget. According to the budget. But actually cost how much? But actually, what was our variable overhead? The actual variable overhead? Are you seeing the actual variable overhead? This is variable overhead. This is the actual. Actual is 4,500. 4,500,000. Okay, sorry. For the actual is 4,500,000 because the figures are in million, are in 1,000. So what do you get? Adverse, favorable.
Adverse.
This is adverse. The company incurred more compared to the budget. This is adverse. This is adverse. You report that is 900,000. You report. This is working number 900, negative 900,000. Then next, very fast, next. Efficiency. Efficiency is like the way we looked at labor efficiency. Efficiency, then here we are going efficiency. To make one dress, you need how many hours? You need the 1.5. This is like labor efficiency variance. You made how many dresses? 900 dresses. 900 dresses. Would have used the how many hours? 900 times 1.5. So that is what? That is 900 times 1.5, either hours, but actually used what? But actually used, put here the hours worked. Hours worked were 1,200. So favorable, adverse. Favorable, adverse. Favorable, adverse.
Favorable.
This is favorable. The difference is this one minus this one minus this. This is favorable, but this is in terms of hours. Convert. So you are going to multiply by the standard variable. Standard variable overhead per standard overhead cost per hour. Do you have that? Do you have that? Do you have the standard variable overhead cost per hour? Do you have it? Are you seeing this? Per hour you are paying 3,000 as variable overhead. So multiply 150 times 3,000. You get this. So that you report here. This is working number 10. 450,000. 450,000. So that's all you add. Negative this plus this. That's what you get. Now go to the last one. The last one, that is, let me do it from here. Let me do it from here. This is not number, for you, as you do those ones, be naming. This is not number 11. Not number 11. I need what? I need fixed overhead expenditure. I need fixed overhead expenditure. Still, here you'll be asking yourself, fixed overhead expenditure. The budgeted fixed overhead costs. You're simply getting what? You're simply getting the fixed overhead expenditure. You're simply getting the you're simply getting the now, because with fixed overhead expenditure, I don't want to, as you handle fixed overheads, look at this. This 6,000, this is for dress. So get this 6,000 times number of dresses. You had budgeted to make how many dresses? You had budgeted to make one.
Is it 6,000 or 27,000?
It is 6,000.
That is
Fixed overhead. Fixed overhead.
Yes.
Don't look at this. That one will take time if you want to look at this. That one will take for you a lot of time. Just look at this 6,000 and know that it is per what? Per dress. Then ask yourself, what were the budgeted dress, budgeted sales, budgeted number of sales, sorry, number of dresses. So a budgeted fixed overhead, I simply get 6,000, then times the budgeted number of dresses, 1,200. I get the budgeted, the total budgeted fixed costs, 6,000 times 1,200. Then what is the actual fixed, overhead costs? The actual fixed overhead costs are simply what? The actual fixed overhead costs are simply how much? From the question, it is 6,150, but since they are in 1,000, this is 6,150,000. 6 million, this is 6,150,000. Adverse favorable variance. Adverse favorable. This is favorable. The company incurred less compared to what they had budgeted. So you report because this is already in amount. So this is
So we have
favorable.
ignored the, excuse me.
Those ones leave. For this one, don't waste time. You use this approach. I'm giving you shortcut. You use this approach.
Okay.
You use this approach. Whereby you're not going to be looking at what? You're not going to be looking at Simani 1 hour would have the 1 hour costs this 4,000. Then you do what? You convert. That one will take time. That one will take time. Okay. For fixed overheads, rely on the cost of the dress. What is the fixed cost on the dress? The budgeted fixed cost. Then fixed volume. The last one. Fixed volume, because we need the last one here. Fixed volume. Hey, let's first report. This is working 11. Working 11, the amount is this one. Then the last one, fixed volume over fixed overhead volume variance. Fixed overhead volume variance is what? Volume. Basically look at the budgeted units. The budgeted units, compare it with budgeted with actual units. Actual units. You had budgeted how many units? 1,200, but the actual units were 900. 900 dresses. So simply get the difference. Adverse, favorable. This is adverse. Isn't it, guys? This is adverse. The variance is adverse. The variance is adverse. Okay? But this is in terms of what? Yes, please.
Excuse me. I thought it is the favorable.
How?
You budgeted to use 1,200. Okay.
No. We budgeted to make, okay, as a company, you always wish to do what? To make less or to make more? As a, for you to have a favorable position as a company.
Oh, okay.
Look at that, from that angle. Okay, then here we need to convert it into amount. So we are going to multiply by, this is where students normally make mistakes. So here, this is amount is in terms of what? This amount is in terms of dresses, isn't it? So this figure is in terms of dresses. So here you will multiply by what? You multiply by the standard fixed overhead overhead cost, overhead cost per what? Per dress, because the figure you have here is not these are not hours, these are dresses. So you convert, we want to know how can we convert that thing into what? Into amount. So how can you get fixed overhead cost per dress? Do you have it? Do you have fixed overhead cost per dress? This is
4,000.
overhead per hour, not per dress. So fixed overhead cost per dress. Do you agree that it is 6,000?
Yes, I do.
You agree? Do you agree that this is the one that is based on per dress? This is 6,000 per dress, per a dress. This is the 6,000. So that is where students normally make mistake. That's where students normally make mistake. They end up using this, yet what they are converting are dresses. Okay, so we are going to use the other 6,000. Yeah, we use 6,000. All right. So when you multiply, what do you get? When you multiply, what do you get? That's what
1.8.
we get. And you report this is working number 12, which is negative 1.8 million. And you're done with the number. So add and get total overhead. Get this positive plus negative. You're done. Now the question is, if you consider what you have here in this column, do you get this or not? If you don't get this, know that you're wrong, but don't cancel. Because by the time you reach here, time, just move on. Just move on. When you find that things have not reconciled, move on. So let's see. Now you need to get this figure plus. If a figure is negative, make sure that on your calculator you put negative. Me, I just add because already they are in negatives. Then plus, this is positive 9.6 minus 5 or 5.1 because that is a minus. Then I'm going over. I'm doing what? Let me first confirm. Plus what? Me, I'm going to just be saying plus because these are already negatives. Then plus, have I skipped? Oh, sorry. We don't have material. Let's first get material we didn't add here. This plus this. So you make sure that when you add, you should be getting exactly. For you to be sure that it has reconciled, you should be in a position to get this. So let's see, basing on this last column, get this plus negative this plus a positive plus. Okay, me, I'm saying plus because it is X plus, but for you, make sure that if a figure is negative, you subtract. If a figure is positive, you add. So that's there you are, and your thing is what? Your saying is what? You are saying is reconciled. Now, we are going forward, you will meet some scenarios where this fixed overhead volume is categorized into two. It is categorized into fixed overhead capacity, and efficiency. So when you get capacity plus efficiency, you get the volume. Here I have just simplified. That is for next time. I don't think I can stretch beyond this. I'm done with today's session. Any question? Any question? I hope you have gained something. I hope you have gained something.
Yes,